It's time for Wise Money with Korhorn Financial Group with financial advisors Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of Wise Money with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being with us. My name is Mike Bernard. I am your host. I'm also one of the certified financial planners on the show. With me in the KFG studios, my business partners and friends, Kevin Korhorn and Josh Gregory.
If you're like most investors, 2019 came as a wonderful surprise for you. But most of you may also be skeptical about what's in store for 2020 as well. What are the forces that will drive the markets, and how should you position your investments for the year ahead? That and more on this hour of Wise Money.
That's right. We're talking about investing. We don't talk about it often because it's just one area of your entire financial life, one of six, but it's got our undivided attention today. If you have questions, we'd love to hear from you. You can find us online, wisemoneyshow.com, and submit a question right there. You can call or text 574-222-2000. That's 574-222-2000. And then all over social media, wherever you're at, we're there too. Just search The Wise Money Show, and you can submit questions there as well. Okay, so were you surprised by what the market did in 2019?
Absolutely.
Not at all.
I knew Kevin
I knew he would
that.
lie. I knew it. I knew it.
Okay, so I never get wrapped up in these predictions, but a friend of mine, as 2018 was coming to a crashing close, he sent me a text and, oh, hey, Happy New Year. This is over a year ago at the beginning of 2019. Hey, Happy New Year, blah, blah. Hey, what do you think the market's going to do? And which is just a total bait. And I fell for it and said, normally I don't do this, but my guess is the S&P 500 will finish in the 3,000s, maybe 3,100. And I lowballed it. Like that was a true guess, and I just figured we weren't heading into a recession, things would bounce back and all that. And yet I was surprised at how well it did.
Yeah. I mean, what a massive year, and we'll get into the numbers and everything, but just think back to what you were feeling, though, a year ago, because after the fourth quarter of 2018, things had fallen almost far enough to classify the decline as a bear market, which we've been waiting for years to experience again. And a lot of people were wondering, well, are we in the bear market, but we just haven't triggered that status yet? We just haven't hit a low enough threshold before we'll consider the market having kind of reset itself, and now we'll go into a long increase over many years. And who knows? I mean, coming out of 2018, I remember, again, a year ago, the Fed had been raising interest rates for a while, and a lot of people thought they had really messed up. And there was really no indication whether they would correct that problem or not. And so if you thought 2019 was going to be potentially a rough year or a choppy year or maybe even a negative year, I think you were in good company coming into 2019.
Well, and if you think about the mindset of people, the way we're hardwired, you would logically think 2020 is going to be a negative year because what?
2019.
Say again?
2019?
Right.
I mean? Yeah.
That's what I said. So you would logically think 2019 is going to be a bad year because 2018 was a negative year. Yeah. So that's what we take what has recently happened and we project it forward and we say, well, the from September to December the market gave up 30-some%, finished on the year down about 6%, and so you think, well, in 18 the market was down 6%, so in 19 it'll be down 6 to 10% again, and that's what we're prone to think like.
So what actually happened? Let me run through the numbers really quick. Essentially, nothing worked in 2018, and pretty much everything worked in 2019. Large cap U.S. stocks, again, the winner, if you would call it that. I mean, I think investors are the real winners here, but large cap U.S. investments up 31.5%. Small caps up 25%. So that's pretty good. International lag behind, but still at 22% positive. Emerging markets up about 19%. Real estate was actually the leader most of the year, actually going into the fourth quarter. and it sort of had a flat fourth quarter where U.S. large cap stocks jumped, but real estate was up almost 29%, and even bonds. These slow, steady, everyone's been negative on bonds since I started my career nearly 20 years ago. Bonds still posted an almost 9% rate of return. So no matter where you look.
Those are total return numbers.
Correct,
that you're,
yeah, that's right.
Listing there, right? Which
Yep.
you may do a little bit of your own research and say, boy, the U.S. stock market wasn't up that much. Well, that's because stock prices increased, but those same U.S. companies were also paying out profits in the form of dividends, and that gets added to the rate of return that you earn for the year.
Yeah. So here's yet again another problem when you're looking at how your investments did compared to that list I just shared. You're likely comparing what you did to the U.S. large caps, so 31% or so. Now, you didn't do that because you likely had a mix of all of those that I shared and likely a decent chunk in bonds. And so most investors probably did around 20% last year if you're diversified, and you should feel good about that.
That is a fantastic rate of return.
That's incredible. And so I wouldn't compare with envy to that 31% and think, oh, geez, I got ripped off or I picked the wrong stuff or whatever. No, be ecstatic about the 20% or so that you
Well,
got.
just to give you some perspective, I mean, if you have a diversified portfolio and you are positioned for the long term, to earn 20% in 1 year or 21 or 22 is more than double what you would expect in an average year.
Right.
So it's years like 2019 that help drag the average up. And you know that there are years like 2018 and other years mixed in there as well that lag well behind 20%, even lag behind the 6 to 8% that we would hope you'd earn over the long haul.
Yeah. All right, so we're going to talk about what to expect in 2020. However, why did we get these results in 2019? And honestly, I feel like it was probably one of the most underappreciated, phenomenal years in the stock market that I can remember. I mean, posting a return like that, and yet all along people were just skeptical and just didn't really enjoy the ride. But really, what happened and why did we get those results?
Right. And I think a big part of the reason why people didn't really enjoy the ride is it was a pretty miserable ride. So other than that, it was great. But I mean, seriously, when you look at that, the market was, if we're just talking the S&P 500, and that is not your portfolio, but that a lot of times when people talk about the market, what's the market doing? So the S&P 500, well, the S&P 500 at one point this past year was down 7%. So, and for a good part of the year, I mean, what happened, the goodness that happened in the stock market was really at the very end of the year.
Yeah, we had a surge in the first quarter, basically till May, to recover from the fall of 18. And then things were flat from May until October. You know, you got trade war stuff, you've got other things that made the market bounce around. And then the market surged, the Santa rally came early and mid-October, and it went, soaring right through the end of the year. And so we really had two advances in the year that made up for these returns. I already mentioned one of the things that really contributed to the returns. That's the trade war stuff that we really we think it's mostly on the right trajectory, but now there's still even lots of questions about it. But that certainly influenced markets last year.
Absolutely. And at some key points as well. I mean, getting a new deal with Mexico and Canada, replacing NAFTA, that's a big deal. And certainly the president is using that as a template for future negotiations with other countries as well. So the markets can kind of look at that and say, okay, maybe there's more of this goodness to come. But there's a saying on Wall Street, don't fight the Fed. There's a saying for everything on Wall Street, I think. But that's an important one because if the Fed is lowering interest rates, which is stimulative to the economy, you don't want to bet against the economy doing well in an environment like that.
Right.
And if the economy is doing well, then you would expect that the stock market is predictive of that positive growth as well.
And there was an about face with the Fed in 2019, actually right at the end of 18 into 2019. And so we're going to talk about that. That greatly influenced the market. Plus, my list is still several other bullet points long. And then how does this all boil down to what you should expect for 2020 and how you should position your investments? We've got that and more coming up here on the Wise Money Show with Korhorn Financial Group. All right, YouTube, thanks for being with us. This is the Wise Money Show. This is the Wise Money Show channel. So thanks for being with us. If you're not already a subscriber, I'd encourage you to hit that button. Turn on the bell for notifications as well. Leave a comment below. Thumbs up, thumbs down. Share the content. Really, a lot of financial planning is focused on how your investments are doing and so on. Hopefully you come to the Wise Money Show for wise financial principles all the way around. But investments, of course, gets a lot of attention. So if you have any comments, questions, just leave them below. Thank you. Okay, so I was looking for that text that I sent my friend Randy. You met him once. I'm pretty sure I said 30, somewhere in the 3,000s, maybe 3,100. And what did the market finish at? 32 and change. The S&P 500.
You're so smart.
Yeah, 32
You
and
are.
change. No, this is so anyway. If
Start
you're
calling
watching
you
on
Nostradamus.
Nostradamus. So
The prognosticator.
that to predict where the market's going to be at any given time is truly you're trying to predict the future. No one would have expected the Iran conflict we saw just a couple weeks ago that influenced the market. No one would have expected that, right? How could you have guessed that was going to happen and accurately guessed what that would do to the markets in the short term? There's no way. There's no way of knowing.
Yeah.
And so we're looking at bigger themes here as to what's driven the market.
I mean, going down the line, I mean, no one knew what was going to happen with impeachment. No one knew that the U.S. MCA was going to get passed. No one knew that the trade deal with China was going to get to where it got. I mean, all of these things, there was great uncertainty. But, and I'm just going to go out on a limb and say no one, although that isn't perfectly true, no one knew how much liquidity was going to get dumped into the market.
Right.
I mean, you want to talk about don't fight the Fed. Oh, my word. Mm-hmm. This is why you have to participate in equities.
Mm.
Yeah.
Because if you don't, you're going to get passed by.
All right, well, let's pick it back up with the Fed, and then we can kind of finish a couple of the themes that drove the market in 2019, and that can move us right into what we expect for 2020. Sound good?
Yep.
All right, ready? After an incredible year in 2019 in your investments, how should you position them for 2020 and the year ahead? What's going to drive it? And what do you need to do today to make sure you capitalize? We've got that and more. This is the Wise Money Show with Korhorn Financial Group. Thanks for being with us. My name is Mike Bernard. Here with me in the KFG studios, Kevin Korhorn and Josh Gregory. Thank you to the attorneys at South Bank Legal, as well as First State Bank, for sponsoring the Wise Money Show. We appreciate that. Thank you very much. To stay up to date on all Wise Money content, you'll find us online, wisemoneyshow.com, and then all over social media, just search Wise Money Show. Make sure you're following us there. All right, so what else drove the markets in 2019? Again, this very underappreciated, phenomenal year. We left off with Josh talking about don't fight the Fed. And let me just say, going into 2019, there was all sorts of history being written about the Fed causes recessions, and the Fed's going to cause this one by their missteps, and they're going to raise rates. They expected 3 times in 2019, and we actually reduced rates 3 times, right?
That's right.
So, yeah, the Fed has completely changed their position, and it's gotten a lot of scrutiny. However, you would argue that they haven't seen a lot of inflation, and therefore they justified in trying to keep the rally going, and they don't need to have interest rates high because inflation seems so tame.
Well, and they were also dealing with something, and I'm going to get real nerdy here for a second, but you've heard us mention this on this show before, the yield curve. The yield curve had flipped upside down, which is an unnatural place for it to be. And the yield curve, if you don't recall what that is, it's basically just a scatter plot showing all of the interest rates in the economy. And you would expect that short-term interest rates would be lower than long-term interest rates, and they weren't for a while there. And so the Fed was trying to lower interest rates and get that put back to normal again. And that's part of what was going on. And the reason we pay attention to the yield curve is throughout history, it's often seen as a predictor of a recession that's coming.
Yeah, I think it's predicted 14 of the last 7 recessions. Honestly, I know that Kevin says that with a little more humor, but it inverts, and sometimes that means there's a recession, and sometimes it doesn't. So ultimately, though, the consumer's been really strong, and that hasn't really helped most retailers, but it has certainly helped the housing market. I think we ended 2019 with a record high housing confidence ratio. I'm not sure. I don't have the exact data in front of me, but home builders have record high confidence because of the amount of demand that they're facing. And when the consumer is healthy, that typically means for the upcoming future, the market should be pretty healthy too. We know that can change on a dime.
Well, and that's because we have an economy that is driven by consumer spending. Mm-hmm. It's by you and me and all our friends and neighbors just spending money on a daily basis, and that's what drives the economy. And you mentioned the consumer being healthy. And I saw an interesting chart recently that shows household debt payments as a percentage of your income are about as low as I've ever seen them, certainly in my lifetime.
You know, it's interesting, though, the headlines out there that Americans have the highest credit card balance that they've ever had as well.
Uh-huh.
But it just
if you look at the payment compared to your income, it feels smaller than it's ever been before.
I'm just going to give you some advice right now. If you fall in that statistic where your credit card balance has kind of crept up higher than it's ever been before, get that thing paid down.
Absolutely. Get
that thing paid down. Before the next recession, before the next, I wish I would have, just work on that thing right now, especially after the holidays. You're starting the year maybe in the hole. Get that thing paid down.
Yeah, I've gotten that sense as well. I mean, the issue with what we're seeing towards the end of 2019, it feels like to me, and again, I don't trust my feelings when it comes to this stuff, but it feels like we're starting to heat up, not necessarily overheating, but it feels like we're starting to heat up. I mean, Warren Buffett says, hey, when people are fearful, you should be greedy, and when people are greedy, you should be fearful. And the problem is people look and they say, well, the technology sector was up about 50% last year, so I'm going to now move my chips into technology because I would be happy with half that return. And that is the wrong way to approach investing. But there are a lot of things that are happening. One of the things that you asked, Mike, about what were the surprises this past year, I think, and it's easy to gloss over this or forget about it. One of the surprises that we have is that there wasn't a recession. I mean, in the middle of this past year, if you turned on the radio or picked up a newspaper, I can explain to you younger folks what that is. But there's these newspapers that they print stuff on, and you would have thought that the sky is actually falling.
You said in this past year, people have been predicting the 2019 recession since 2015. They have been plotting out what was going to happen with interest rates and the yield curve and said, bam, 2019, watch out.
Right. So, but there was a pronounced season, let's just say, of talking about, hey, this recession is coming, this recession is coming, this recession is coming. So here's the reality. Don't listen to that stuff. Period. Don't listen to it. What you need to do is make sure that you are recession-proofing your household.
Yeah.
So, I mean, do what Mike's talking about.
If you're not following us on the YouTube channel, check us out there. We've got a vlog video about how to prepare for the next recession. So if you haven't seen that, check that out. All right. So what's ahead for 2020? You know, expectations. What's going to drive it? I mean, I'll just start with the big one.
Yeah, I was going to say, have you heard there's an election this year?
There is an election, I think, in the United States at some point in 2020. And so there's that will obviously sway things. I remember when George W. that year he was reelected, the market was basically flat. I mean, it had some ups and downs right up until the election, but then you look at the year, and I think it finished positive 15% or somewhere around there, and it all came from the election on. But the market, hating uncertainty, was just sort of treading water until then. I think we have enough going on that I don't see us treading water, but obviously the election's going to play a big role.
It will, and regardless of the outcome, I mean, it's so far away, and yet all eyes are glued to the Democratic, process right now. And Republicans, obviously, we have our candidate. Who knows who's going to win the full election in the fall? But here's what we know: it will surprise a bunch of people. It will surprise them on what the impact will be with their investments. I mean, think back to the first time that Trump was elected. There were many people that thought the investment world was just going to spiral out of control and be horrible.
They had to shut the futures down overnight.
Yeah, the night of the election, it was down 900 points.
So they suspended trading, and the next day the market was positive.
Yeah.
So there are many people who bet the farm that, first of all, they could predict how the election was going to go, and then how the outcome of the election would impact their investments. And that's just a fool's game. You are not investing for the next year or even the next presidential term. Whatever you're investing for is a long-term goal that will span many presidential terms and really be driven by the economic engine that really it supersedes what a presidential impact can really have.
But let me talk to you out there. If you are thinking, hey, the candidate on one side or the other, if that person wins, I'm going to have to take some drastic measures in my portfolio, I would really encourage you to not think along those lines. Yeah. I've actually seen it. I've seen people who were convinced that if Barack Obama was elected for another term, that the world was going to end, and so they actually did take measures in their portfolio. And it doesn't. That is not a winning game. If you are in it, if you're playing the get rich slowly long game, the way to do it is to have a strategy and follow your strategy, not try to outthink it. And it's very tempting to say, hey, I know if this person gets elected, what's going to happen. Therefore, I'm going to, and especially right now, with the market being up over the last 10 years, you say, well, listen, I would be fine. Well, guess what? The people that did that last November missed out on 15%.
And for those of you that don't know Kevin very well, I mean, it's not coming from a politically neutral source there. Kevin loves politics and has very strong views, and yet that's wisdom that you shared about investing through it. There's several other things that will impact the markets, and then we've got to talk about what should you do with your investments for 2020. So that and more coming up here on the Wise Money Show with Korhorn Financial Group. Yeah, that is an interesting. I'm so glad you brought that up, Kevin, because
I've seen
if
it.
This, then this.
Right. And it is easy. I mean, I can totally see. Actually, I could do it right now.
Because the markets will respond in the short term to however the election, whatever the result is. You know, I mentioned the George W. It's easier to bring that one up because it's less emotionally fueled right now. But yeah, there was obviously lots of people that didn't want that to happen, and yet for some reason the market loved it.
And
went straight up.
And I can tell you, as polarized as our country is, you're pretty close to being right if you said half the people were convinced if Trump was elected, we were going to HE hockey stick and it wouldn't take very long.
Yeah,
and
you know what?
And the other half was convinced if Hillary Clinton was elected, the exact same thing was going to happen. And I look at this and I think, okay, there is a certain resilience that our economy has, but it's not just the U.S., right? I mean, if you're participating across the board, you want to get to a position where you don't care what the U.S. does, if that's possible.
Yeah.
And that means recession-proofing your household and diversifying your investment portfolio.
All right, well, let's talk about a couple of the other issues. I think just maybe honorable mention or some additional thoughts with what we've already said. And then, Kevin, you took us there. You've got to have the right strategy. So let's share a little bit about what the right strategy might look like. And then, I doubt we'll get into listener questions, but if we do, we got a great question recently.
I have those up.
More of a comment by an individual who, right or wrong, we're going to talk about it, is quite convinced that using his Roth to buy rental real estate is a foolproof, obvious choice. And so he didn't really leave a question. Does this seem like a good strategy? But anyway. Oh, okay. But we'll talk about it.
Yeah. So we're going into the third segment.
Going into the third segment.
And are we on the predictions?
Yeah, we're in predictions. Any additional thoughts? What's going to drive the market for next year? And then all right, well, let's boil it down. If part of your strategy is reacting to what Jim Cramer says or what the headlines are, what's a different strategy? And so we'll share our strategy, our investing strategies. All right. Ready? How should you invest for 2020? There's actually something you should do right now to make sure you're positioned appropriately. We've got that coming up. This is the Wise Money Show with Korhorn Financial Group. Thanks for being with us. My name is Mike Bernard. Here with me in the KFG studios, Kevin Korhorn and Josh Gregory. Thank you to Bethel University Adult and Graduate Studies, as well as Diane Bennett and her Inspired Homes team. Josh, was I right? I'm pretty sure Bethel University had a top 10 play on SportsCenter around the new year.
An amazing dunk.
It was an amazing dunk. I watched it 3 times. Like, really? Bethel University? Wait, our Bethel?
I think they're still undefeated.
Wow.
They have a pretty awesome team this year.
Oh. If you're not listening on the YouTube channel, I'd encourage you to do that. You get all the bonus content. Of course, there's vlogs as well. We talked about recession proofing. We've got a vlog about that. Next week, we're going to be talking about the new Secure Act. It doesn't sound familiar. It will impact your financial life. It will. Mm-hmm. And so tune in next week, but also make sure you're following us on the YouTube channel. We've got a vlog out there about that. Just go to YouTube, search The Wise Money Show, subscribe to it, turn on notifications as well. All right. Before we get into what you should be doing with your investments, especially right now, what else is going to drive the market in 2020? Election, of course. What else?
Yeah, I think the ongoing trade discussions will be a theme that many investors are going to be watching because it has implications for economic growth, not just here in the U.S., but in other economies as well. And we're kind of all in this together, as we've said in the past. If China catches a cold, we may get it as well, right? Yeah. And so there's kind of high stakes going right now on a lot of these trade renegotiations, and it's bigger than just, hey, is it going to be fair? Isn't it going to be fair? How quickly can we get the economic engine really roaring in both countries because everybody wins in that situation?
I'm watchful for a surprise from the Fed. If the economy is stable, and if consumers continue to spend, and if we see some expansion in GDP, everyone's expecting still in the 2%, which is very low, which that doesn't really yield a lot of inflation, okay? But if things really heat up and we start seeing inflation, I'm watchful for the Fed. If we don't see that, then they've said we'll keep rates normal, and everyone's expecting that. But if we see things start to heat up and they start increasing rates, that could be a big surprise. So Fed decision, as always, I would be watchful for that for 2020. Also, it boils down to economic growth. I mentioned GDP, but all of this noise, who's going to be president, what the Fed does, consumer spending, all of that, they're all sort of indications of what might happen to corporate profits. Corporate profits is what actually drives the market. Yeah. That's it. And so, of course, economic growth will be in focus for 2020. with all of that, then what should you do with your investments?
So, and I'm happy to talk about that, but did you want my predictions
Well, okay,
for
sure.
these
You're going to
various...
take the bait.
Yeah, I think...
Wait, I want to write this down.
I want you to write it down. So, and it'll be preserved for posterity.
On the internet.
Yeah.
The internet never forgets.
That's right. So on the election, I'm predicting there will be one in November.
Okay.
And there will be a peaceful, I predict a peaceful continuation of power. I think it would be very, very difficult if you just look at data and statistics. First of all, you have an incumbent president, but you also have a roaring economy. So you put those two things together, and it would be pretty tough to imagine a scenario that there's a change of regimes in Washington. The Fed, I think they will continue to pump money and liquidity in, which is one of the reasons why you want to make sure your portfolio is where it should be, because you want to participate in that. And then I think we're going to continue figuring out trade deals. I have a good friend who is an asparagus farmer, and in the deal that was just done, they got hurt. Mexico can still dump their product for the 2 months that Michigan is producing their 26 million pounds of asparagus. Well, and basically the way they can get around the no dumping rules is they just average out the price over the year. So Mexico's average price is fine, but basically they're giving it away while the Michigan farmers are harvesting their crop. So trade is way more complicated than any of us give it credit for, and there's often times where your ox is going to get gored, and you make it or break it based on factors that are beyond your control.
Yeah.
Which is confusing, because when you make it based on factors outside of your control, you're tempted to give yourself the credit and say, I am amazing. And then when something bad happens, you say, well, look, it's not my fault. So I think trade, we're going to keep going. I think Brexit is going to happen. I think Boris Johnson is going to be able to pull that off. If he's able to pull that off, some of the other countries that in the European Union are going to start sniffing and saying, hey, I don't want to have the burden that this collective has, so set us free as well. And I think, I think economic growth will continue. I think with the number of people that are employed, and we're at full employment right now, and that gives upward pressure on wages. And so there are a lot of positive reinforcing upward spirals that are happening as we speak. So I would assume that based on everything that is knowable and seeable, 2020 is going to be a great year. And I don't know how long it will last, but I do think at some point in time, whether it's 2020 or some point in the future, there's got to be a tragedy that causes America to deal with their runaway spending. And because the bureaucrats in Washington won't deal with their runaway spending, we're going to have to. And it'll all be fine until what? And what's the event? I don't know. But it's going to be an unforeseen event. And the difficult thing about unforeseen events is you can't see them.
Right.
And so
Kevin saw it here first.
Yeah,
you won't be able to see it.
And so, is the dollar not going to be the reserve currency for the rest of the world because of Bitcoin and blockchain and all these other technologies? I mean, who knows what's coming or when it's coming? So I would not operate in fear, but I would operate in awareness. I would operate in gratitude, because if you start with gratitude, you have a shot. And then I would operate in awareness. Hey, listen, there are some things that are being done that should not be happening. And because of that, and I'm going to put the blame squarely on all parties in Washington. But because of those things, there are difficult days coming that we cannot imagine. So I would say just prepare yourself.
Yeah, and maybe that's the message there, because everything you shared initially was kind of your thesis on how the economy and how the investment world may perform in 2020. It's based on facts. It's based on some assumptions of what those facts mean, and all of us have some sort of a thesis on what we think could happen.
Yeah.
Okay, and maybe your thesis is just it's unknowable, so who knows? But the point is, you shouldn't bet the farm one direction or another. And that's where taking a disciplined approach with your investments is always going to be what we preach.
Yep.
Right? And one of the most important things that you can do that is within your control, and you dictate the timing on this, is rebalance your portfolio. What we know is that last year had an amazing effect of growth on your portfolio, some areas more than others. And some of those areas may have grown to kind of nudge out or take up more of the portfolio than other areas, and it's gotten maybe a little out of balance. And so sometimes one of the most disciplined things you can do is a difficult thing to do, and that's to sell a little bit of the winners and buy some of the stuff that you don't really love right now. And it's for the sake of maintaining the right mix of investments for the long haul, not for your short-term thesis necessarily.
Love that idea of rebalancing. There's two additional thoughts that I would have. And then we've got a great question from a fan of the show who's talked about, well, should I invest in more real estate? So we've got that and more coming up here on the Wise Money Show with Korhorn Financial Group. Great.
That's good, Kevin.
So, rebalancing, check your risk compared to your long-term goals. And then, making sure that you have diversification. So having a momentum strategy or making sure that you're, properly diversified. So.
Yeah, so I would say, number one, have a strategy. I mean, I was I can't remember who I was listening to, but they were talking about how if you fix your allocation, that could be, if you're young and you fix your allocation, that could be the biggest financial move you ever make in your lifetime. So I'd say fix your allocation, and then if you're going to go into your retirement plan, your 401k, click the auto rebalance. Now, I personally like a monthly rebalance. Some people like a quarterly, a semi-annual, or an annual, but technology is doing that for us now. Mm-hmm. So click your rebalance. When you're in there, make sure that your beneficiary designations are correct. And then, what were the other ones you said?
Well, rebalance.
Diversification.
Yeah.
And assess your risk according to your long-term goal.
Yeah, I think that doesn't make any sense to anyone. I think it would make more sense to say assess your resources relative to your long-term plan.
Okay.
That's just, if in the spirit of being nitpickety.
What's your third one there, or are you trying to come up with it? Because, would you have something about momentum? Yeah, momentum struggled last year because of how things cycled. But
It's
still
a hard one for people to pull off on their own.
Yeah.
I don't think I would, because I don't think that I think we lose people.
Yeah.
Well,
what I was going to say is, if you've got those three, I would share those exact three, make it succinct, and we'll communicate that, and then we'll transition to Andre's question. All right, ready? should you invest in real estate inside of your Roth IRA? We've got that question from a fan of the show coming up. This is the Wise Money Show with Korhorn Financial Group. Thanks for being with us. My name is Mike Bernard. Here with me in the KFG studios, Kevin Korhorn and Josh Gregory. If you love listening to podcasts, you will find the Wise Money Show on podcast. Wherever you listen, just search the Wise Money Show. Subscribe to it. So whether you're out and about, if you're shoveling snow, if you're doing whatever, okay, you can listen to the Wise Money Show. And please rate the show for us and leave comments as well. We appreciate that. All right, so before we jump into questions from fans of the show, let's succinctly then, I mean, people have been listening the whole time saying, just tell me what to do for 2020. And so what is it, Kevin?
Okay, get your pad and your pen or pencil or your device, depending on what generation you're from. So number one, and Mike said get these down to 3, so I've got my I'll show you a way to get 16 into 3. But seriously, you want to fix or confirm your allocation, and that's basically the mix of how your investments are allocated. So with stocks, you want different flavors of stocks, and with bonds, you want different flavors of bonds. If you're young, this could be one of the biggest financial decisions you'll ever make in your lifetime. A little story, I met with a client, and they were transitioning, and they had some money in their retirement plan, and we went online, they logged in to their 401k, printed out their statement, and their rate of return since 2001 was a little less than 1%. And they said, see, I have this awful 401k. And the reality is I had another client that worked at the exact same company that their rate of return in that same time period was a little bit north of 10%. And you say, wait a minute, you had 2 terrible stock market, bear markets in that time frame. How is that even possible? I'll tell you how it's possible. If you're buying in through that, you're winner, chicken dinner. So make sure you are buying in to the right mix. And technology is making that easier and easier and easier to do, so I would say confirm you have the right allocation. And if you don't know how, make sure you seek out a competent financial planner. That would be a certified financial planner.
So did that client just have too low a level of risk in their portfolio? They
jump
weren't
out at the wrong
growth-oriented
time?
enough? or
Well,
what?
they did a couple of things. They had they zigged when they should have zagged a couple of times, and then towards the end of the last couple of years, they'd had it all in the money market account because of their certainty of what was going to happen. And certainly they were wrong. So you want to make sure you've got the right allocation. And then the second thing is then rebalance your current investments to those. And so this does not apply to everyone, but if you have a 401k right now, log in and go to the automatic rebalance function. And if you did number 1, which is confirm you have the right allocation, then click to rebalance. I personally, and statistically, this isn't going to make much difference at all, but I personally like the monthly rebalance because there are some times when things, spike up a little bit, and so you sell a little bit of that. But you don't do it yourself; it happens on autopilot. Right. So you are not thinking. You want this stuff to be automatic. While you're in your 401k online there. The other thing I would ask you to do is check your beneficiary designations. Those may or may not be correct, so go in and update those as long as you're at it. I know that has nothing to do with your investments, but that your loved ones will care and thank you later. And then number 3, I would assess your resources. So what have you been able to assemble and amass resource-wise relative to your plan? So think about that. Think if your financial plan is your Waze or your Google Maps or whatever your MapQuest that you printed out or or your State Farm Road Atlas or whatever you have. But make sure that you have a plan, and make sure when you look and you know for sure, am I ahead of pace? Am I behind pace? Am I right on? Think Goldilocks and the Three Bears. Too hot, too cold, just right.
I'm glad that we're here. And in the fourth segment, we're finally turning the conversation from just investments to investments in the context of your plan. Because a certified financial planner's job is to help you figure out what is the right mix of investments for you, so that regardless of what 2020 has ahead of us, what is the mix of investments that's going to take you to your goals far beyond 2020? Mm-hmm. And so, yes, it's fun to talk about and to be interested in what the market's doing and what will it do next. But ultimately, what is your plan, and how are you going to position your investments to take advantage of whatever the market does?
Yeah, I had an interesting thing. We sold some stuff on Facebook Marketplace, and the guy that came to pick it up said, "Hey, I have this gal that keeps pursuing me from one of these local organizations, and she's telling me about this team of experts that she has in St. Louis that can really give us some great ideas on how to invest my money, and she wants to invest my money, and she thinks I need to invest. And I said, "Hey, how's your plan?" He said, "What plan?" I'm like, "See, you don't need someone who sells investments. You need someone who walks with you through your life and helps you create a plan that you can follow."
Yeah.
Because the reality is that team of experts hasn't come up with greater results than.
But the fear of missing out, the get rich quick, the could I change something in my investments and have it be the next Amazon, that is very alluring. But the get rich slow, the right principles, the right process, the right habits, that's really the surefire way to get there. So. Which sort of leads into a great question from a fan of the show. I wanted to sneak this in when we're talking about investing because Andre shared a couple weeks ago his philosophy. I just wanted to throw that out there and get Kevin and Josh's and share my take as well. And basically, I'll summarize it in within his Roth IRA, he's looking at investing in rental real estate within the Roth, and says when you add appreciation, the mortgage deduction, rental income, you can earn returns north of 20% easily. Real estate inside the Roth would be a very powerful way to grow my portfolio tax-free compared to a traditional mutual fund that just earns 5 to 10%. What do you guys think? I would be careful. I'd be careful of that. Number one, you don't get the mortgage deduction when it's inside of your Roth. I mean, that doesn't you can't get it.
He's talking about rental real estate, but
I know, but that see, this is where if you don't know what you don't know, you there's a risk there, because the mortgage deduction suggests that there's a mortgage on the property, and if there's a mortgage on the property, you have to watch out for UBTI. Mm-hmm. And if you don't know what UBTI is, what you want to do is take the 3 steps that I just mentioned and fix your allocation and rebalance your Roth IRA and keep your life simple. Because if you want to talk about an incredibly complicated way, if you want money to invest in rental real estate, it shouldn't. This is my opinion. It should not be coming from your Roth IRA unless you have an absolute ton of money in your Roth IRA, number one, and you enjoy complexity. Yeah. And if you really, really, really enjoy complexity, then I would say go for it.
And that's the voice of experience there. You've
Yes.
been a landlord.
Yeah.
It is a lifestyle decision as much as an investment decision.
Right.
And you may not like that life.
Yeah.
I remember a client who was heavy into rental real estate, and he told me he's got 35 toilets he's got to worry about all the time. And that's all I needed to hear
That
right
stinks.
there.
Yeah. And if you break it down with rental real estate, when you actually look at the cost, property taxes and insurance, blah, 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 and then, assigning any value to your time, the actual rate of return is not that significantly different than what you'd see elsewhere in passive type investments. So we'll probably pick up on that in a future show. But thanks for the comment, Andre. We appreciate it. And all right, that's all the time we have for today. On behalf of Kevin Korhorn, Josh Gregory, myself, and all of us at KFG, have a great weekend. We'll see you next area for Wise Money with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.